Hello, hello, hello. Welcome to Al Stock Trades. All right, guys, in this video, we're going to go ahead, and I don't listen to CNBC like maybe once in a while. There's a few people I like to follow. This guy is a chief investing officer. He knows what he's talking about. So I want to share with you what this guy's saying. And again, this was published 3 weeks ago. And again, only 7.8 thousand people were watching it. Due and due part of CNBC losing, obviously, retail investors are starting to get educated now, realizing that CNBC is not as is okay. They bring on some great people, but in this video, you're going to see the reiteration of what we've been saying regarding small caps. And by the time you exit it, it's going to look good. All right, so let's go ahead and watch this. Hopefully you guys can hear it.
John Maury is CIO and senior portfolio manager at NFJ Investment Group, had every dime of his client's money in Eli Lilly for the last 5 years. It's unbelievable. John, it's unbelievable.
So I'm going to go ahead and fast forward this bullshit small talk.
We'll say the concentration is definitely
Lilly, John.
We do not, but I will say the concentration has definitely been the way to be the last several years in the market, which is actually an interesting pivot to what I think is where the value is.
So how have you been managed? So you mean you had the Magnificent Seven? That hasn't been a bad trade either until just recently.
Well, so going back to October of 22, Joe, we actually got very bullish on equities, and we got over.
He says that Magnificent Seven has been that bad of a trade until recently. Yeah, until basically you started talking about it, because whenever you talk about it, it's too late when it becomes like mainstream on their front page. Let's go ahead and talk here.
So how have you been managed? So you mean you had the Magnificent Seven? That hasn't been a bad trade either until just recently.
Well, so going back to October of 22, Joe, we actually got very bullish on equities, and we got overweight cyclicals, we got overweight semis, we got overweight home builders. We thought the defensive areas were way too expensive. And I know you've had many guests on that were predicting a recession last year. We stayed away from predicting the recession call. What we did predict, though, was that the valuations were too discounted in cyclicals. So we got very overweight. So we did have many of the semis, including NVIDIA, that have performed very well. But today, Joe, we see a very different landscape evolving. And one of the areas that I would like to advocate for are small caps, because if you look at the dispersion between the valuation and small caps today, you've got one of the biggest opportunities, I think, going back to the 1990s. And one stat that I'll share is that if you go back to the October lows of just last year, small caps are up 25%, but the S&P is up 22%. So
all right, there's a lot. A lot was just said right now. Let me just go ahead and share the screen so I can move around here. A lot was said. Number one, he said, I don't know what happened to you guys last year when you guys were basically not advocating to buy the market. You guys were saying the market was overvalued, calling for a recession. And I told you, in a recession probability every year is approximately 20%. So whoever tells you it's higher than that doesn't know crap, because not one person has predicted a recession successfully and continuously. Whoever tells you they can is full of shit, and they want to clickbait you. Okay. Number one. Number two, he said that we believe that since the October lows, it has been a great time to be in the market. And if you don't recall, you can go back to our videos back in October on our history, and you'll see that we made a video in October saying small caps are about to explode. Okay. And, again, not a lot of people watched it. It's okay. We're a small channel. For all the people that are watching, thank you for supporting our mission. And, hopefully you guys get rewarded. So the third thing he said is that if you go ahead and take a look at the SPY, the S&P 500, and if you were to look at them between here, so let's just zoom in right now. Okay. This is large caps. This is the S&P 500 large caps. Okay. And if we were to zoom in here, and if we were to just look at this is the October 27th, 2023. You go ahead and look at that. The S&P 500 increased by 27.37%. Now, if you go ahead and take a look at small caps, now a lot of people that are uneducated are going to say, oh, small caps haven't been basically outperforming. Small caps haven't been doing great. Shut your mouth up, you uneducated dumb person. Okay, look at it here. October 27th, the S&P 500 is up 29.65%. And that's what that person is doing. That's what that person is referencing. This increase, 29.65%, versus the S&P 500's increase of 27.37%. Guys, that 2-3% difference amounts to trillions of dollars, okay? And he's going to talk about that. But essentially, you have the small caps now technically outperforming large caps. Already, we are starting to see it. Most people, because that's all they look at year to date. And year to date, yes, small caps are up 5.4%. Large caps are up 10 point, S&P 500 is up 10.67%. But an investor who's an astute investor is going to look at October lows, because that was the biggest rally. That was the turning point when the Federal Reserve became dovish. So this goes back to what Brandon was saying. Rate cuts incoming for June. I don't know when rate cuts are going to be coming. I don't like to play that game. All I know is once the Federal Reserve starts to cut interest rates, this discrepancy in small caps and large caps are going to be so huge that trillions of dollars will be erected in the market. And not just that, it'll be erected in small caps. And it's going to rise like you haven't seen before. All right, number 3 or 4. He went ahead and talked about, we see a lot of great opportunities here that we haven't seen since the 90s. This is what he is looking at. If you look at the ratio of small caps to large caps, the last time we were this low, it was in 1999. The Russell 2000 outperformed the NASDAQ index for 9 years. Guys, we are in an area of no return. I am so excited for this. And all we need is all the small cap stocks that we talked about, especially the one, my favorite one, needs to get to that profitability matrix and increase their revenue. We are going, the market is about to enter the bull rally. Dogecoin millionaire now, he's back to being a millionaire, okay? These are all prognostic indicators that shows you the money is about to come back, okay? And that's what we're waiting for, okay? So let's go ahead. And again, it's going to be a party like it's 1999. And again, I'm not making this stuff up. Look at the data, okay? Look at the data, all right? So again, yeah, lots of videos. There's a lot of things I wanted to talk about here. Okay, so let's go back now. Let's unshare the screen here, and let's go back and let's go to the video here, and let's replay. Not replay, but like watch the rest of it.
The small cap index is actually beating the S&P 500 off the October lows. And I'll share one more stat real quickly on.
Okay, and that's what I just showed you, right? The small caps are beating large caps from the October lows.
On why we think small caps are interesting. The Magnificent Seven have a total market capitalization of 13 trillion, okay? The entire small cap universe is 3 trillion. So if you have just a 10% correction in those big stocks, that's half of the entire market cap of the Russell 2000. So,
okay, that's half of the entire market cap of the Russell 2000, aka that's literally a doubling, a 100% return on small caps. What he's basically trying to tell you is a 10% reduction where people are going to traffic out of the overvalued stocks that have shot up to the moon, and large caps are going to be trafficked into small caps. Okay, that's how Wall Street works, baby. Retail investors like us have to be ahead of the game using data-driven decisions. And that's what we're doing. You have to be ahead of the game. You can't like go in front of the wave. You gotta know and study the wave. The wave is about to come and is about to freaking go into small caps. Okay.
So a spoonful out of the ocean could be a big wave for small caps.
Yeah, people have liked them so long that they probably don't like them anymore. And now probably is the time. I don't know anybody.
Yeah, no, of course. Yeah. Now people don't like him anymore. Yeah. Well, that's when you do like him. Be fearful when others are greedy, and be greedy when others are fearful. And he's about to attack CNBC producers, and this guy might actually get fired. Watch.
So long that they
listen to what he says. I'm going to go ahead and slow it down. Listen to what he says.
Probably don't like them anymore. And now probably is the time. I don't know anybody. You should have been calling our producers in October of 22, because people that like the market in October of 22 are far and few between.
Yeah, you should have called our producers back in 2022 and 2023, because not a lot of people like the market. And you should have called our producers because everyone was telling you it's a bear market. We're going to go into recession. Dude, there were people that were bullish. It's just that CNBC likes clicks. It is easier to sell doom and gloom. CNBC's ratings go up whenever there's a freaking war, and they salivate on that. CNBC people, when there's people killing each other, CNBC loves it. They're like, all right, guys, stick around, folks. Let's go ahead and talk to you about destruction, because that's the only way our media company makes money. It's disgusting. Same thing with CNBC. All right. They like to peddle recession. So of course they're not going to, this guy, you should have called our producers. No, screw your producers. Your producers should understand what intrinsic value calculation is. Your producers should understand what like Jim Cramer should understand what market cycle dynamics are. But guess what? They do understand. And there was a video from Jim Cramer saying they use CNBC to manipulate the markets, right? But guess what? We have YouTube now. We have, I may be shadow banned or whatever, but we have an ability to communicate, okay? And I'm telling you, you can't, the rates are about to come down. We don't know when, but we know they're coming down. Okay. We are about the end of the tightening cycle for this economic cycle's fiscal tightening policy. We're about to make a shit ton of money. All right, let's go ahead.
Everybody on the street was predicting a return to the October lows all through 2023 till the end of the year, and the market left everyone in the dust.
No, the market left retail investors that listen to you in the dust, because if it's true that the market left everyone in the dust, then how the hell did the stocks go up? It's because people bought them, you dumbass, right? Hedge funds bought them, okay? Institutional investors bought them, right? It's just your viewers were left in the dust because they're uneducated, right? And now your ratings are going down because places like Twitter, places like X, Y, and Z have started to become the main hub for information dissemination. And now people are looking at you that like the next CNN head about to basically get chopped and blocked.
It's true, and I think the big reason for that, Joe, that everyone got overly focused on the narrative and
recession,
throwing out the fact that valuations were steeply discounted, particularly on price to book, which is what you should be looking at when you have an earnings recession in stocks, which is what we got a year and a half ago.
So is any way this year going to be comparable to last year? I know you like small caps, but so it'll be.
Anywho, I've been always a bull on the market because I like to be
different,
greedy when others are fearful. Okay. And unfortunately, if you look at our returns from our portfolio hedging modeling system, we did really well. We outperformed the crap out of the market, right? If you look at all our stock picks within our stock terminal, okay? But it's just unfortunate because this is how CNBC runs. But guess what? In the future, things may be changing. But in the meantime, you know what? That's fine. We can make money off of people's ignorance and people's innocence, because this is what this is.
Different type of advance, maybe a broader advance, but it will be a solid year overall for the averages, you think, John?
I would be very surprised if we do not have an up market this year. I mean, typically following a big down market like we had in 2022, you should expect positive returns out of equities. But again, I do think it'll be a little bit different. And I think that, the sneak preview, Joe, was in October of last year, because if you look what performed well, it was the yield sensitive areas. It was banks, it was REIT.
Anywho, he was about to say banks and financials. Yes, I do believe one of our analysis, if you look at our for our stock terminals and our research edge, we believe that small caps and banks and financials are going to be outperforming because nobody wanted to touch banks because of the Silicon Valley bank collapse. We do believe that this year is going to end positive. I am expecting some type of downward shift momentum with recession fears, and is the Federal Reserve going to cut too late fears. But ultimately, I'm very excited. I'm very bullish about the market. And yeah, guys, it's all in the data, okay? It's all in the data. And I hope that these videos are helpful. Erected, let's go. Let's party like it's 1969. And by the way, yes, I know you're stock beast, my friend. I know the names of my people. Okay. All right, ladies and gentlemen, I hope this video was helpful. And yeah, guys, I mean, you cannot lie about the data. Okay. You could go ahead and spin any narrative you want. You can't lie about the data. I'll see you on the next one.